Good afternoon. It's September the 16th, 2015, and this is our introductory webinar on our 3-2-1 methodology that's been developed and honed since 1989. So there's a lot of positive history behind CNFT's methodologies that are really based on trading the information developed and thrown off by the market profile. We differ from other organizations, software vendors, is that our software is specifically designed around the market profile to capture the information in the profile and allow you to profit from that. Capital markets are driven by statistical distribution, and you see it everywhere. The average trading range, 70% probability that the trading range will be this, 10% probability that it'll break out of the range, 70% probability that the move's over in 2 days, 90% probability that the move's over in 3 days, 99% probability that the move's over in 5 days. So you really do have to have an understanding of statistics if you are going to compete effectively with those very, very large institutions that comprise and constitute the capital markets. Modern statistics had its genesis with Carl Friedrich Gauss a long time ago, and he developed the rules and laws for a normal distribution. And so much of the world runs on statistical informations, etc. And this is what a normal distribution looks like. Now what's different about market distributions is you can see right here this skewing. We have a tail right here, and you can see in the red shading we've got a tail over here. So in the markets we deal with non-Gaussian distributions. We don't get this symmetrical distribution. We get something that looks like that. And it's this tail right here that we have to deal with. And if you've ever wondered why Bollinger Bands don't work as advertised, it's because you're trying to apply a Gaussian statistical study to a non-Gaussian distribution, and that's why it doesn't work very well. So this is the basis. This is where it started. I look back on my college experience, and I was a math major, calculus, all sorts of stuff, mechanics, before I switched to business. And what I have used since leaving college on a regular basis has been statistics. I've never used that calculus. Pete Settlemyer graduated from Berkeley, University of California, Berkeley, affectionately known as Berkeley, and he went to Chicago to be a trader. And Pete recognized early on, given time, that a normal distribution was forming in front of him, and he came up with what was called the market profile. When it first started out, it was the market logic profile, and it was introduced to the trading world in 1985-86, and it was immediately adopted by the fixed income markets and the currency markets. It took a long time to get to the CME contracts, the NYMEX and the COMEX contracts, but it's there too now these days. The history on the profile, I still think one of the very best books is the CBOT Market Profile Handbook. If you don't have that, let us know and we'll get you a copy of it, file. And then Settlemyer's on Markets, Trading with the Market Profile, second edition, is really probably the second best book out there. There's a lot of other books on the profile, but this is the father of the market profile, and that's the guy that you should read first. So Pete came up with x-axis, y-axis, time on this one, price on the vertical axis, and he separated each bar into a 30-minute time frame. And that came from the CBOT's back testing of all of their statistical information, all of their history since the start of the exchange, and they found that the 30-minute distribution was 30-minute bar, 30-minute time frame would catch moves early enough where you had a lot left in them and would eliminate most of the noise. 70%, 67% of the volume takes place between the value area high and low. So market profile based strategies are going to give you about a 67 or a 2 out of 3 success rate. And that is vastly better than any technical analysis study out there. I mean, you can't even compare them. Most technical analysis studies are right less than 20% of the time, and that's why you should take a hard look at the profile. Statistical distributions in the market profile. What Pete did was he and the CBOT, they separate. This is a 30-minute bar chart right here, and each letter represents a specific time of day, and it's the same every day. So Y period is 8:20 Eastern, Z period is 8:50 Eastern, A period is 9:20 Eastern. And over time you'll find out that markets do certain things in such and such a period. And what you did to get a profile out of that was that you left justified. You moved all these letters to the left, and that gave you a distribution that looked like this. Now, my software internally was developed in 1992. I went public with CQG in late 1997 and 98, and they liked my volume distributions, and they put them out beside the TPO distribution. So these letters represent what were called the time price opportunity, and then CQG added volume to the side like that. And it was very, very helpful. And what you can see on this particular distribution is that down here, we'll talk about it later, but you've got a P, and then the market moves up, and we've got volume right here. The next day the market opens in this area, tries resistance, the top of value, can't get through it, and you can see that volume is down here, so volume is moving lower in the distribution. You can see it in the value area. This value area is lower than the preceding distribution, and the market, lo and behold, breaks. Now what I noticed differently in the early days is that these time price opportunities, TPOs, just the letters, there was something more to it than that. And what I discovered was it was volume. And I tore into the liquidity data bank, which is no longer offered, and found out that volume was the key. So my contributions to the industry are as this long-term distribution on the right side of the market, and I took this volume letter, I took the volume and I overlaid it over the top of the letters so you couldn't miss the skewing. It was impossible to miss. Plus, I got to see a lot more days on the screen. I wasn't looking at 2, maybe 3 days. I was looking at 1, 2, 3, 4, 5, 6, sometimes 5 or 6 days. And more information is better. So this long-term distribution came from me. The volume overloads and time price volume came from me. Everything I did from 1992 on, we either simulated volume, and from 1998 on it was volume. And volume is the key. Markets go up because there's more buyers, goes down because there's more sellers, and the only way you can track that is through volume. You can't track that through price. We use price volatility to execute and get better trade location. So with the classic market profile, and it took Pete till 2011 to recognize the importance of volume, and part of that was because he developed the market profile, but he came up with time price opportunity. At this time, at that price, there was an opportunity for buyers and sellers. Single distributions, they didn't combine distributions in the old day. Every day was kind of a standalone, and without the volume, the letters simulate volume, but they don't quite give it to you. So you had a perception that the market was going to move higher versus reality that the market was going to move higher. And you segregated, you isolated each individual day. Well, the modern way of looking or using the profile is called time price volumes, and you see those now VPOCs as opposed to TPOCs, volume price control. So TPV as opposed to TPO, and this came from me. It didn't come from anybody else. Multiple distributions as opposed to a single distribution, and because we're looking at volume, I would maintain that is reality. And it was the unification of price and volume that makes the modern profile theory much more powerful than the old, at least in my most humble opinion. So why trade the profile? Between these two groups right here, upwards of 70% of the volume that's done on any given day is done by these guys, and they know the profile. So market profile is widely accepted with very, very large institutions and those that trade a lot of money. You can see the capital flow. You can see which way the market is moving through these distributions by which way the volume is moving. Out of self-defense, you really ought to make yourself conversant or familiar with the profile. I mean, it'll save you a lot of grief. 30-minute time frame was back tested by the CBOT, Chicago Board of Trade, and it was the most efficient time period to use to look at markets with, and we see that every day. Through the market profile, you get the market's directional bias, and if you get the direction right, what else do you really need to know? Think about that. I mean, if you say the market's going higher, and it does go higher, the only way you can't make money is to buy the high. If you say it's going lower, the only way you can't make money is to sell the low. So getting the direction right, most important decision that he has to make every day. Very, very efficient price information. What you see in this display is time, price, and volume. No other single display puts all three of them together at the same spot. And it forewarns of directional changes before the fact. So right here we've got this low and I period. J and L were higher. M were higher. P were higher. And you can just see that we're getting higher lows right here, and lo and behold, eventually the market trades up. Market closes here. The next day it opens there. It comes up. It retests this area. That was rejection. Got a two-letter ledge right there, and now you can see that volume starts to move lower in the distribution, and the market does trade lower. So understanding how volume moves through these distribution, understand that, if you're willing to sell a lower price, take a less efficient price, not the price that you really want. That means you want to get a trade on. And you can see that in these distributions and in the profile. And that's what makes it very, very important. 3 rules, 2 patterns and 1 indicator. That's what we roll with, and it's good. Keep it simple. The more variables you have, the tougher it is to make a decision. So we take a minimalist approach to the market, and I'll show you why. 3 rules. The first rule is low volume numbers are support and resistance, and we lean against these numbers. We just have limit sells. We got protective stops up here, and it's great risk reward. If this number holds right there, you have to get back to this high volume number. I mean, there's no other way. This is resistance. Resistance held, you're going to go back to the high volume number, which we define as value. And this is the area where large institutions can trade. So institutions will start hitting the bids up here, and they're going to drive the price down until they get to this area, and then there's bids and offers at that same price, and they can make the trades that they need to make. High volume numbers are like magnets or attractors. I mean, the market can't go any place but to that high volume number. For resistance to support holds, it gets back to that. Institutions will bid it up, offer it down till you get to that number, then they'll trade back and forth at that price. And the third thing that we look at is new moves come out a middle. We've all gotten burned on breakouts. In fact, 2 out of 3 breakouts are false signals. So most people think a new move starts when you come up here. And that certainly is part of it, but the move actually comes off this balance point, and what happens is that the offer is rolled down until it's too cheap to sell, the bid is rolled up until it's too expensive to buy, and then one large commercial order upsets the balance and it's off to the races. And we like to execute, actually, if we're on the buy side, we want to buy beneath that market, and if we're on the sell side, we want to sell above that, and we'll have plenty of opportunities to do that. So if we want to get long down here to retest that low, so if that low holds, we've made some profit. We don't want to be buying a false breakout when it goes through. Ultimately, trade location is what determines whether you have a successful trade or not. And you've got much better trade location here than you do buying up there. 2 patterns. If the skewing in the time, price, volume distribution is a P, then the market biases to the upside or positive. And you just see it right here. I mean, right here we've got a P, market trades up. Right here we have a P, the market trades up. All these are P's, the market trades up. Now we have a B right here, and yet the market traded up. So that could be the first sign of that the market's getting ready to turn around. But this first B that we get in the up move is profit taking. So when you see a B in an up move, that's long liquidation. But again, if I put these two together, I'm really dealing with another P. But this is our first indication that the market might be getting ready to go the other direction. And that's an important distinction that you have to make, so you can anticipate, so you can strategize, so you can plan ahead, not get caught reacting. If the skewing in the TPV distribution is a B shape, then the market bias is negative. B, the market's selling. You say, well, Charlie, I got a little P there. Well, that's true, but you can see that volume is low. And if I were to move that over there, we would certainly be looking at a B. A B. Put these two together, a B. I get a P up here, but you can see it fails to get up into this area, and then the market breaks and sells. And the market comes down. So this is one great big B right there. This is a great big B right there. And what happens? The market does sell and does go down. And what are you tracking? You're tracking this purple or red or magenta line right here. Volume is moving lower in the distribution. And when this volume comes up, it does not build volume against that number right there. Therefore, it's got to retest these lows and or go lower without a new piece of news. It's just the way that it works. One indicator. As the market, if you understand market theory, as the market moves higher or lower, eventually the buying or selling dries up, and they won't buy it because it's too expensive, and they won't sell it because it's too low. Therefore, the market goes up until the last buyer is bought. Now, most of you that are just getting in the futures game think the market goes up until the sellers overcome the buying. But when you come in and look at the dome, there's bids and offers at every price in that dome. So there's somebody out there that's going to buy or sell every price point. And so what really stops the market from moving higher is it's too expensive for the buyer to buy it. He won't pay up. It means the market has to pause or retrace. So this pink square or pink diamond says the buying has dried up. On the downside, the blue square or blue diamond says the selling has dried up. So that's our indicator. When we get deceleration, the buying or selling has dried up, and we get our patterns, we can take a trade. So right here, one of our best patterns is this retest failure, where we're retesting those highs and those bars, and we've got the requisite deceleration. So when we break that bar's low, we're short. We had a pattern. It also happens to be at the value area high. We have an advantage. We're above volume. This is where volume is. So worst thing that can happen to us is that we're going to get down to these numbers, and we might take them out. And in this case, they did take out. Here's another retest failure, and the market breaks. This is the delta in each bar. That's the net buying, selling in each bar. And when you go short, you want to see a red bar. When you go long, you want to see a blue bar. That's your first confirmation that you're on the right side of the market. The bottom on this chart is cumulative buying and selling, and you can see that peak buying came in this area right there on that bar, and then long liquidation begins, and the market sells, and now we have new shorts coming into the market, and the market continues to sell. So tracking what's going on with volume and understanding market theory is how you prosper in this game. Quick review. 3 rules for our methodology. 2 patterns, 3 rules, 2 patterns to watch for, and 1 indicator, deceleration. So we have a sound methodology that's been developed since 1988, 1989. The rule set is very, very concise. Our way of looking at market gives you quantitative insights into who's doing what to whom, who's operating beneath the surface of price. Pairs fundamentals with what you see going on the screen, the technicals. It's a very objective approach to the market. And it shows you trader motivations. If the market, if you're seeing Bs, that means somebody's willing to sell a lower price. If you're seeing Ps, somebody's willing to pay up to get into the market, and that's your trader motivation or sentiment. And you have the reality of volume. The only way you can see whether people are willing to pay higher prices or sell lower prices is through volume. Think about it. Volume is the key. So the 3 rules: support and resistance, we trade them as such. Those are limit buys, limit sells against those. If we get rejection, we're going to get back to that high volume number, maybe more, and new moves come out of the middle. We're watching for those. Our two patterns are B's and P's. A P means retest resistance and or trade higher. B means retest support and or trade lower. Shows the skewing within the distributions. We're looking for that skewing between volume and time. Quite often it's matched, but if it's not matched, that's your key. Our one indicator, the market goes up until the last buyer is bought and the last seller is sold. So we've got a square or a diamond that shows you that the buying or selling is drying up. And this buying or selling drying up would be the concept of divergence. You know, this market's higher, the price is high, but the buying is drying up. Or this market's low, but the price is low, the selling is drying up. Something might be getting ready to happen. And then you go to your methodology to see what that might be. Okay, how do you make a decision under our methodology and our hierarchy? Well, the F1 screen, this is the daily. And this is where the idea originates, whether we want to be long or short. Then we move to the F2 screen and we refine that. If these two screens are in agreement, then that's a pretty strong sell or buy. If they're not in agreement, then that probably means trading range. A little higher, a little lower, but probably going to break out. Then off this F2 screen, we get our support and resistance levels. And we like to be short above the mode mean. We like to be long beneath it. And then we see where the market should trade. And usually the markets are going to go a little bit higher, a little bit lower, but generally move sideways. So idea confirmed, level. Then on our F4 screen, we execute. That's where we put the idea into play. And that's a 3-minute chart. Now what I'm showing you right here is just a regular old bar chart. I'm going to show you the difference between our equilibrium chart, the market profile information that's included in that chart, and how it can really aid or help your decision. Right here on this bar chart, this is down, this is up, this is down, this is up. I mean, 4 little bars right there. One's up, one's down, one's up, one's down. Which way is the market going to go? I really don't know. So if I'm long into this, I mean, the pressure's building to take profits or exit that trade. But if I put this screen on top of it, you can see with this line right here, the magenta line right there, that it's not going anywhere. Volume is holding, and volume is above that volume. And in fact, on this bar, volume moves higher. So if you wanted to add to your position, a buy stop would be appropriate. And then once we're in the trade, this is where we track the auction over here. We see if there's more buying, more selling, and we can read it with a very, very fine-tooth comb. So idea, confirming the idea, level, execute, and then we monitor the trade right here. So it's a very, very simple approach to the market. It's about as lean as you can get, and we keep the variables as few as possible so you can make your decision in a more timely fashion, and more often than not the right decision. Okay, I've gone through our slides right now, and we'll pick up questions when it's all over. Right now we're going to go into the software, and I'm going to show you how this works. And what I'd like to show you first is we came in today on the E-mini, and because of the FOMC we thought that the market would be in a trading range, but we had our sell points well above where the market was trading. We thought the market would go up. So the decision right here, I've got a higher low, higher high, higher low, higher high. I'm taking out these highs, I'm taking out this high. So the decision on this screen is to be a buyer going into today's market. This was the what it looked like yesterday right there on that close. And this is today's action, and you can see that the market actually did trade higher. So we came into this market wanting to be a buyer. On our F2 screen, this is what we looked at this morning. So this is yesterday's action. We can see that the volume is definitely P in the overnight session, and volume is above that. And we can see in the A period that volume is not below yesterday's volume. That was volume from yesterday. So we're dealing with a P right here, so the buy is confirmed. I came up with the idea to buy 60s to 65s, and I thought the market was going to trade higher, so I really wasn't interested in a short till 75 till 80. That was sell 1, and then sell 2 was 85. So the bias was to the upside, so we were fairly aggressive on the buy side, wanted to get involved in this area, and then the market opens up and we have to deal with reality. And so you can see that the market does open and it does trade higher, and we eventually got to our number 2 sell area. So how do you execute a trade like that? The idea is to find a place to get long, and right back here is the opening, and we're hoping to buy 65s, and the low is 68. So here is a setup for us. It's a retest failure. And the market's chopping, it's not going anywhere. But you can see a little bit of selling right here. Goes pretty flat, and then you can see from right this point on, that bar, it just really goes to the buy side. And you see a lot of buying in here. And that buying stays with the market all the way pretty much into the close right here. So the buy side was the side to trade from. Now, I want to show you another chart that we think is really going to be very helpful and help your trading. And this is a chart that tracks the different size players and volume. And you can see right here on this one that everybody's a seller. All 4 panels. Market does come down. Right there on that bar, the 50 lot trader and less is on the buy side. The 50 to greater is on the sell side, so the market doesn't do anything. We don't have everybody involved, but look what happens right here on that bar. Everybody is long right there, and the big players, the 50 lot or greater players down here, take the market long, and it goes up and it just tracks. I mean, you can just see that everybody joins the long side. We got selling up there, so we get a little pause, but we don't get selling down here with the large players. We do get selling with the 50 lots or less. So this is a screen where you can isolate as many different cuts, up to 4 cuts in the volume, and take a look at it, and you can really track it. And I really like this screen. I think it really can make a big difference in your trading. And you can see that very little selling is done till we get in this area by the big players. They're taking profits for the day in those bottom 2, and the market just kind of hangs in. And then what happens right into the final close? Everybody buys it up. What are they buying up for? Probably tomorrow's FOMC announcement. Now, so we know we can really take a fine-tooth comb to the volume, and we can see who's doing the buying or selling. Now the next 2 screens I want to show you are the spread, and everybody says, well, treasuries and equities trade the opposite way. And you can see right here that the market, this black line is the spread, and it's on a 3-minute basis, and it's very fast. The spread rolls over, the market sells. The spread turns up and the market buys. The spread rolls over, the market sells. The spread turns up and the market rallies. Spread turns over and we get a little bit of selling. Spread turns up and it goes. Now the 3-minute, you can actually execute off this information on the 3-minute spread. But if you put this on with a 10-minute spread, what do we see on the 10-minute? I mean, we're just getting nothing but higher lows all the way up. So the 10-minute never really had you much off the long side. In this little area right in here, this chop area, until we turn it right here, could have been short in there, and but you just see we're getting higher lows all the way up, all the way through here. So everything on this screen tells you to trade from the long side, and I think that's important information. I think that can really help your trading. And we do this on the E-mini. We've got that indicator that's specifically developed for the E-mini, showing difference between treasuries and the E-mini. It's kind of a bastardized or specialized spread. And then I want to show you on the 30-year what it looks like. and I want to bring in these other two spreads. So due to scaling issues, we can't put these two screens on together. This is a 3-minute spread, going back to the opening and picking up this high right here. And I'll bring the 10-minute spread over too, so we can come in and just take a look at it. Now this is the knob spread, and again it's our version of the knob spread. When this blue line in the number 2 pane is going up, it means the market is in a rally. When it's pointed down, it means the market is selling. And the 10-minute is really a better, longer term indicator. And what you can see right here, let's just isolate. Market looks pretty good in here. It's run up, it's gone above that high, and here we sit on this bar right there, and that's that bar right there. It's this bar right here. And what do we have? We've got a lower high, so we've got divergence on the retest of that. And we certainly have divergence on this in the classical sense. And if we look at that third point right here, this one, this high is lower than that, and this high is certainly lower than that. So we have divergence all the way down, and this is to me is probably the simplest read on which way the market's going to go next. And so utilizing the spread information, I really think can help make a big difference in your trading. We have a pretty exhaustive support system in place. All throughout the day you're getting a news feed and screen captures on Twitter. On Facebook it's filled in a little bit more. And on YouTube we have a big presence. On YouTube we recap every day our trading in the ES and the ZB, and sometimes other contracts, but that's our primary focus. Although we do cover crude, gold, the euro too. I think you have to be in touch with all markets to do that. So there's a lot of support there for you. We extending an offer of $147.50, which is half price for the first month. For those of you that want to come in and check us out, look at us a little bit more, and you go to our website right here, cnfuturestrading.com, and this is our web page right there. So come to that web page, interested in trading CN Futures Trading right here, fill out this information, submit, and you get a link to the room that we run every day. So it's pretty straightforward. So how do we differentiate ourselves from somebody else? The market profile is a tool, and you can just see right here there's just hundreds of different depictions on that, but the profile is easy. It's a tail, it's range extension, and then it's a P or a B, and it's no more than that. And your first directional indicator is this tail. Range extension confirms it, and then over the day you'll get a P or a B will form up. But what we have is a methodology designed on the profile and a model of how to trade it. So we got both, and that's a huge difference. You know, most people that supply software are anything to everybody, and we're not. We're specialized. So that's another way we differentiate ourselves. So our contact information, info@cnfuturestrading.com. There's our telephone number. There's our link to sign up, and hopefully you'll be on board for our next webinar. Thank you so much for being with us. I wish you all a great evening. I'll see you bright and early in the morning.